Forex fundamental analysis focuses on understanding the major factors that drive currency movements in the global market. Interest rates play a key role because changes made by central banks can increase or decrease a currency's value. Inflation is another important factor. When prices rise quickly, it affects the purchasing power of a currency and signals economic conditions. GDP, or gross domestic product, shows the overall economic output of a country. Strong GDP growth usually supports a stronger currency. Central banks influence markets through their monetary policies, including setting interest rates and managing financial stability. Employment data, such as job growth and unemployment rates, provides insight into the strength of the economy and can impact currency demand. Finally, geopolitical news, such as elections, conflicts, or international agreements, can create uncertainty or confidence in markets, causing currencies to rise or fall. Altogether, these factors help traders understand and predict Forex market behavior.
How interest rates directly influence the value of a currency. When a central bank raises interest rates, the currency becomes more attractive to investors because higher rates offer better returns on investments. As a result, more foreign capital flows into the country, increasing demand for that currency. When demand rises, the currency strengthens and its value goes up. On the other hand, when a central bank lowers interest rates, the opposite effect occurs. Lower rates make the currency less appealing to investors, reducing the amount of foreign capital entering the country. This decrease in demand causes the currency to weaken, and its value falls. In simple terms, higher interest rates tend to strengthen a currency, while lower interest rates tend to weaken it, because investors always look for better returns on their money.
How the non-farm payroll, or NFP, news release affects market prices and trader reactions. NFP is a major U.S. employment report released every month at 8:30 a.m. Eastern Time, and it often causes strong market movements. Before the news is released, the market usually stays in a buyer reaction zone, where price moves slowly and traders position themselves based on expectations. Once the NFP numbers are announced, volatility typically spikes. This means the price can move very quickly and unpredictably, creating sharp jumps either up or down. After this initial volatility, the market enters a seller reaction zone, where traders who believe the price has moved too high begin selling, causing a reversal or correction. Overall, the infographic shows that NFP releases create sudden changes in market behavior, starting with calm price action, followed by a dramatic spike in movement, and ending with traders reacting strongly in both buying and selling zones.
How CPI, or the Consumer Price Index, influences inflation and ultimately affects the value of a currency. It begins with rising CPI, which means the prices of everyday goods and services are increasing. When inflation rises, consumers need to spend more money to buy the same items, which reduces their overall purchasing power. As a response, the central bank may step in and raise interest rates to slow down inflation. Higher interest rates make borrowing more expensive, which helps reduce spending and cool down price increases. This central bank action can affect the currency in two ways. In many cases, high inflation leads to a weaker currency because domestic goods become more expensive for foreign buyers and imports cost more. However, if the central bank raises interest rates aggressively, the currency can strengthen because higher rates attract foreign investors looking for better returns. Overall, the cause and effect relationship shows that rising CPI leads to central bank decisions, which then influence whether the currency depreciates or appreciates.
This infographic outlines a simple and effective strategy for trading the Forex market using fundamental analysis. The process begins by checking upcoming news events, especially economic releases that can move the market. Once you know what news is scheduled, the next step is to analyze the high-impact data related to those events. This includes indicators such as interest rates, inflation reports, employment numbers, and GDP results. After gathering the data,
You compare the market forecast with the actual results that are released. The difference between expectation and reality often determines market direction. Instead of entering a trade immediately, it's important to wait for the initial burst of volatility to settle, because the market can react unpredictably in the first few seconds or minutes. When price movement becomes clearer, you can then enter the trade with confirmation, meaning you follow the directions supported by both the data and the price action. This approach helps traders reduce noise, avoid emotional decisions, and trade with greater accuracy. A global Forex economic calendar, which is a crucial tool for traders who follow fundamental analysis. The calendar lists important economic events, along with their dates, times, and expected impact on the market. Each event is marked with a volatility level, and in this example, most of the highlighted events have a high volatility rating, meaning they can cause strong price movements in currency pairs. The calendar includes major U.S. economic indicators, such as non-farm payrolls, the Consumer Price Index, the Federal Reserve Interest Rate Decision, FOMC press conferences, and gross domestic product results. For each event, the calendar also shows the forecast value and the previous value, which traders use to compare expectations with past performance. When actual numbers are released, traders react instantly, and even small differences from the forecast can create rapid market movements. Overall, the economic calendar helps traders prepare for high-impact news, manage risk, and plan trades around the most influential events. How fundamental and technical analysis complement each other to create stronger, more informed trading decisions. Fundamental analysis focuses on long-term drivers, such as economic reports, global events, central bank decisions, interest rates, company earnings, and broader industry trends. These factors shape the overall direction of a market and help identify the long-term trend. On the other side, technical analysis focuses on short-term signals. It examines chart patterns, trend formations, support and resistance levels, and indicators or oscillators to determine the best timing for entering or exiting trades. When both approaches are combined, traders gain a more complete picture of the market. Fundamentals reveal why the market is moving, while technicals help determine when to act. This combined strategy leads to more informed decisions and optimized risk-to-reward outcomes. Overall, using both methods together provides a holistic approach that improves market analysis and enhances timing for better trading results.
This chart illustrates how markets typically behave around major news events. Before the news is released, price movement is usually calm and limited as traders wait for new information. This phase is shown as a period of low volatility where the market moves slowly and indecisively. Once the news is released, volatility increases sharply. The candles become larger and the price spikes both upward and downward as traders react instantly to the information. This is the most chaotic part of the chart, and it often includes unpredictable swings. After the initial volatility fades, the market begins to form a clearer direction. This is when a new trend often emerges, either upward or downward, based on how the market interprets the news. In this example, the price rallies strongly after the news, showing a clear upward trend. This phase is where traders typically look for more reliable opportunities after the noise settles and the true market sentiment becomes visible.
Highlights important trading safety guidelines designed to help traders protect their capital and reduce unnecessary risk. The first guideline reminds traders to avoid entering the market 1 to 2 minutes before major news is released. During this time, volatility is extremely high, and price movements can be unpredictable, so it's safer to wait for the market to stabilize. The second guideline encourages using small lot sizes. Smaller positions limit your exposure and help protect your account, especially during volatile conditions, while large lot sizes increase risk and can lead to significant losses. The third guideline emphasizes trading only when the direction is confirmed. A clear uptrend or downtrend provides higher probability setups, while uncertain or choppy market conditions make trades much riskier. Finally, following proper risk management is essential. This includes setting stop-loss levels, defining how much you are willing to risk on each trade, and planning your entries and exits before executing a position. Good risk management ensures that no single trade can damage your account and helps you trade consistently and responsibly.
A quick guide to the most important economic indicators that traders watch when analyzing the market. Interest rates play a major role because higher rates usually strengthen a currency and affect borrowing costs across the economy. CPI and inflation measure how quickly prices are rising. When inflation goes up, central banks may respond with rate hikes, which impact purchasing power and overall economic stability. GDP, or gross domestic product, reflects the health and growth of a country's economy. Strong GDP numbers boost investor confidence and signal a stable environment. Unemployment levels are another key indicator. Low unemployment suggests a strong labor market and healthy consumer spending. Retail sales measure consumer demand and show how active the economy is. Central bank announcements are crucial because policy decisions and statements directly influence market sentiment and currency values. Finally, geopolitical events such as conflicts, elections, or unexpected global news can trigger sudden market volatility and shift risk sentiment. Altogether, these indicators help traders understand the bigger economic picture before making trading decisions.